Stocks are hot, but initial public offerings, also known as IPOs, are not. And despite the very strong rise in broad market stock funds like the Schwab Total U.S. Market ETF, ticker SCHB, and others like it, the IPO market has cooled. According to FactSet, the number of IPOs listed on U.S. stock exchanges contracted by just over 14% in 2019 compared to the previous year. The U.S. government shutdown in late 2018 that lasted until the end of January 2019 contributed to some of that slowdown in new listings as the Securities and Exchange Commission went offline. Last year's IPO market was dominated by large cap technology stocks like Lyft and Peloton and Pinterest and Slack and Uber. Now on paper it seemed like a really strong group that would deliver impressive performance, yet despite all the buzz surrounding these companies, the class of 2019 failed to deliver on the sizzle. The biggest disappointments were Lyft and Uber, which still trade under their offering prices. Moreover, Slack Technologies, which went public via a direct listing, has also underperformed. Curiously, none of the underperformance in 2019's IPO class had a meaningful negative impact on IPO-focused ETFs. The Renaissance IPO ETF, ticker IPO, and the First Trust U.S. Equity Opportunities ETF, FPX, both jumped just over 34% and 30% respectively in 2019. IPO owns a basket of almost 57 newly launched publicly traded companies. The fund has around $42 million in assets and leans heavily towards large cap stocks, with almost 62% of its market cap exposure fixated there, while around 37% is invested across mid-company or mid-cap stocks, with a market size between $2 billion to $10 billion. Companies that have been public for 2 years are eventually removed from the Renaissance IPO fund, which has a very heavy bias, if we look at it, toward the technology sector, which makes up roughly 45% of its weighting at the end of 2019. Now, the fund's expense ratio is 60 basis points annually. So now we're going to compare IPO with its closest peer and competitor. That's the First Trust U.S. Equity Opportunities ETF, FPX is the ticker. Keep in mind, FPX is the granddaddy of IPO-focused ETFs because it was launched way back in 2006. So it had basically a 7-year head start over ticker IPO. And as a result, FPX has amassed around $1.3 billion in assets. Because it owns 100 stocks, FPX is slightly more diversified compared to ticker IPO. FPX holds the largest IPOs by market cap during the first 1,000 trading days, or 4 years on average. The expense ratio for FPX is 0.59% annually. Is there merit behind investing in IPOs? In a recent study, finance professor Jay Ritter, who does excellent research, he's at the University of Florida, he examined the long-term performance results of IPOs. He found that IPOs launched from 1980 to 2017 scored a almost 22% gain for investors that held during the first 3 years. Now, by comparison, the one-day pop that IPOs sometimes experience on their first trading day delivered an average gain of just 17.9%. Now, looking ahead to 2020, investors are keeping their eye on the performance of upcoming IPOs like Airbnb and GitLab. Both companies are expected to use direct stock listings as a strategy by which they are basically bypassing the traditional route that many companies use, which is Wall Street's underwriters, and they're going to list directly on the exchange. Over the past 2 years, companies like Spotify and Slack Technology have chosen the direct listing method. Although IPO investing offers a lottery ticket to own a piece of the future, that's what it's all about, right? We all want a piece of the future. The results can be a mixed bag. And in worst case scenarios, you got the single stock blowups that can really sting hard. I mean, look no further than Webvan, and you also have Vonage Holdings and many others that have failed. But in the end, IPO-focused ETFs offer a happy balance for investors who want to own that next generation of promising companies while avoiding that single stock risk. So instead of concentrating risk, ETFs, of course, retain exposure to these new companies while spreading the risk across a basket of companies and industry groups. And that does it for our discussion of IPO investing and ETFs. I'm Ron DeLegge with ETF Guide. Thanks for watching.